Devyani International is the largest franchisee of Yum brands, which includes KFC and Pizza Hut in India, contributing about 65% to revenues. KFC and Pizza Hut have 600 stores each compared to about 1,500 Domino's stores, highlighting the opportunities to grow the former brands. Devyani International has considerably reduced its margin differential with Jubilant Foodworks, which operates Domino's in India. As it gains further scale, the scope for margins will improve and faster earnings growth would drive re-rating. The stock corrected by 22% from its all-time high in mid-December 21. The correction provides a good entry point for long-term investors. Devyani International posted a record quarterly performance in Q3 FY22. Top line grew 65% YOY, driven by ease of COVID restrictions that led to increased customer outings. Growth was also fueled by rapid store expansion. DIL's gross margins improved 270 basis points, led by benefits of scale and a slightly better product mix. However, improvement in EBITDA margins was lower by 40 basis points. Net profit improved significantly to 63 crores compared to the break-even in Q3 FY21. DIL opened 77 core brand stores, KFC, Pizza Hut and Costa Coffee on a net basis in Q3 FY22, taking the overall store count to 824 as of December. It plans to maintain this run rate of store openings and is targeting overall store addition of about 250 in FY22. DIL plans to open about 200 to 250 stores annually over the next 2-3 years. It's not only opening stores in existing locations but also entering new cities, particularly Tier 2 cities and below. It signed a new franchise agreement with Costa Coffee in August 21 and looks to ramp up store openings. KFC and Pizza Hut are expected to continue strong store addition given the lower penetration of these brands in the country. DIL adopted a strategy of opening lower size stores over the past 2-3 years. It is almost half the store size for both KFC and Pizza Hut formats as consumers increasingly prefer the delivery takeaway format. Lower size stores lead to lower store related expenses, enabling margin improvement. All the incremental store openings are in the reduced size format, which would improve profitability. As DIL expands further and gains scale, it would see benefits of operating leverage. At the rate of expansion, DIL would almost double the store count over the next 3 years. Corporate and other fixed expenses would be apportioned over a much bigger revenue base, which would also help margin improvement. At the current market price, DIL is trading at an EV/EBITDA of about 28 times its FY23 projected earnings, similar to its larger peer Jubilant Foodworks. However, DIL has strong growth prospects compared to Jubilant, given lower penetration of KFC and Pizza Hut compared to Jubilant-operated Domino's. Also, DIL has considerably narrowed the margin differential with Jubilant. Its margin differential in Q2 and Q3 FY22 shrunk to about 230 basis points compared to 550 basis points in FY20. DIL has higher scope for margin improvement compared to Jubilant given the former's relatively lower scale of operations, which implies faster earnings growth as well. We expect DIL's margin differential with Jubilant to shrink further, and hence we're positive on DIL and recommend long-term investors to add the stock to their portfolio.